Welcome to the Deep Dive, where we take the complex source material earnings calls, analyst notes, and just distill what's absolutely critical.
And today, we were tearing into the Q1 fiscal 2026 earnings for the Campbell Company. Ticker is CPB.
This was a big one. A lot of focus on it because it followed a major leadership transition.
Yeah, exactly. This was the debut for the new CFO, Todd Comfort, who was on the call with CEO Mick Beekhuizen.
And they had the fun job of explaining their performance in what they called a, quote, dynamic operating environment.
Which is, just corporate speak for inflation is a nightmare, our supply chains are a mess, and these tariffs are absolutely eating our lunch.
Right. So our mission today is to cut through all of that and answer the one big question hanging over CPB.
Which is how a company can technically beat estimates on sales and earnings, but then see its stock get slammed over 5% on crazy high volume.
Exactly. You need to understand why that market panic happened and, more importantly, where the real levers for future profit are. We're talking about the snacks division and a very, very strategic acquisition.
Let's do it. So the hard numbers first. For the quarter ending November 2nd, if you were just glancing at a screen, you'd probably think it was fine.
Just fine.
I mean, adjusted EPS came in at 77 cents. That comfortably beat the consensus of around 73 cents. So, 5 or 6% beat.
And sales.
Sales were also a small beat, $2.677 billion, which was just a tiny bit above the $2.66 billion everyone was expecting.
Okay, so we beat the top line, we beat the bottom line. It sounds like a win, yet the market reacted like the sky was falling. Why did the stock reverse so hard?
Because that beat, it was totally misleading. It completely masked a, frankly, disastrous trend underneath.
You're talking year over year.
I'm talking year over year.
Yeah.
Adjusted EPS was down a staggering 13% from 89 cents last year. Net sales dropped 3%.
And what about organic sales? That's the real health metric.
That's the key. Organic net sales, still down 1%. That tells you the core business is shrinking. They're losing customers faster than they can hike prices.
So that 1% decline is what the market really seized on.
Oh, absolutely. And the trading action tells the whole story. The stock was indicated up maybe 2-3% pre-market on those headline beats.
And then the call started.
By the end of the day, it closed down 5.2% on volume. That was almost 3 times the average. That's big money, institutional money, basically saying, we don't care about your accounting beat. The fundamental direction of this company is wrong.
Which brings us to the core problem, margins. If sales are going down and earnings are falling 13%, the pressure has to be on the gross margin line. What happened there?
Yeah, that's where the knives came out. Adjusted gross margin contracted by 150 basis points. It dropped from 31.4% all the way down to 29.9%.
For a packaged food company, that kind of erosion is...
Yeah.
That's an emergency.
It's an emergency. And it flowed right down to adjusted EBIT, which fell 11% to $383 million.
So when you break down that 150 basis point hit, how much of it was the usual stuff inflation, supply chain problems, versus this new threat they keep talking about, the tariffs?
The tariffs were the real story. I mean, yes, cost inflation was there, but the tariffs alone had a massive 200 basis point negative impact on gross margin. 200
basis points just from tariffs?
In just this one quarter. Yeah. They said tariffs now account for something like 4% of their total product costs.
Wow. 4% is a huge structural drag. So how do you translate that into actual earnings per share? What did it cost them?
The gross impact to Q1 adjusted EPS was 14 cents. Just think about that. 14 cents. It's an enormous headwind.
But they must have mitigated some of that, right?
They did. They managed to offset a good chunk of it through pricing and cost-saving efforts. So the net impact that actually hit the bottom line was 4 cents for the quarter.
Okay, let's connect the dots here because this is crucial. That 4 cents of net tariff pain is the reason for the volume problems you mentioned. To fight that gross 14-cent impact, they had to push through aggressive price increases.
Right.
That saved their margins a bit, but it ticked off the consumer and drove organic sales down 1%. They're stuck.
It's a brutal cycle. It is the definition of a structural headwind, and management's main response is just execution on cost savings. They're trying to save their way out of it.
What's the goal there?
It's an ambitious one. $375 million in savings by fiscal 28. In Q1, they found another $15 million. So they're at $160 million cumulative so far.
But how much of the tariff problem can they actually solve with that?
They're aiming to mitigate about 60% of the gross tariff impact over time.
Only 60%.
Which means they're basically admitting we can only solve 2/3 of this. The other third is now a permanent cost to doing business, and that's what has the market so spooked.
Okay, before we get to the segments, what about the balance sheet? Can they afford this fight? Is the cash flow holding up?
Cash flow was actually pretty solid, $224 million from operations. That was more than enough to cover their CapEx of $127 million and still return $144 million to shareholders.
So the foundation is still there?
The foundation is sound. They're still deleveraging, aiming for a 3x leverage ratio. So while the P&L is shrinking, the company itself isn't in financial danger. It can fund the turnaround effort.
All right, let's shift from the P&L to the consumer. Where are people actually reacting to these price hikes? We have two big divisions, meals and beverages and snacks. Let's start with the classic, meals and beverages.
Meals and beverages saw a 2% organic sales decline, so right in line with the total company. But it was interesting, there were some real pockets of strength in there.
Like what?
Well, the at-home cooking trend is still helping them. They saw really strong growth in premium stuff like Raos and their broths. And even their condensed cooking soups are actually gaining traction with younger buyers, millennials, and Gen X.
Raos is the star, we keep hearing that. But what about the classic red and white can, the core Campbell Soup business? Where did that 2% decline actually hit?
It hit the eating soups, the ready-to-serve and the condensed eating soups. These are the brands where consumers are just hypersensitive to price. Management basically admitted the price hikes, which, again, they had to do because of tariffs, just weighed too heavily on demand.
So they're stuck. Raise prices, you lose volume. Hold prices, you destroy your margins.
It's an impossible situation, especially, as they said, during the critical soup season.
That sets the table perfectly for the snack segment. Because if meals and beverages is a battleground, snacks was supposed to be the growth engine.
It was supposed to be, yeah.
Instead, it seems to be where all the investor disappointment is focused.
It was definitely the more challenging story this quarter. Snacks organic net sales were also down 1%, but when you dig in, the problem was almost all volume and mix. That was down 3%.
Ouch. 3% volume destruction is hard to come back from.
It is. And it was only partially offset by a 2% pricing gain.
So which brands were the weakest links? I mean, when people hear snacks volume is down, they're thinking of some big names.
They were the biggest names. Goldfish crackers, Snyders of Hanover pretzels, and Cape Cod chips. Goldfish, in particular. That's $1 billion brand. It's a powerhouse.
So to see consumption declining there, even with a big back-to-school campaign, that's a major red flag.
It's a huge red flag. It signals something is really wrong with either their execution or their price-value message. The CEO called reigniting Goldfish a top priority.
I would hope so. You can't let a brand like that slip. What's the plan?
It's a 3-part plan. Innovation, better value messaging, and just tighten up their execution across all channels. But make no mistake, the entire turnaround story for Campbell's hinges on them getting Goldfish right. It's the main event.
Speaking of strategic moves, let's talk about the big news they dropped on the call. With all this margin pressure and volume anxiety, they made a major offensive play, the La Regina acquisition. And this is all about Raos.
This was a huge, really nuanced move. It's all about securing their profitability and their supply chain. They announced a deal to buy a 49% stake in La Regina.
And La Regina is the company that's been making Raos sauces for them forever.
For a long, long time. So they're basically buying their supplier to lock them in.
But wait, it's only a minority stake, 49%. Why is this such a big deal? How does that change the margin picture?
This is where the financial engineering gets really fascinating. The strategy is simple, right? Secure supply, help with innovation, capture more value. But the financial payoff is immediate because of how they structured the accounting.
Okay, explain that. How do you own 49% but get the margin benefit of 100%?
So because of the specifics of the deal they cut, Campbell's gets to consolidate 100% of La Regina's profit and loss, and critically, their gross margin, onto their own books immediately.
They get the full margin left right away.
Right away, which is exactly what they need in this environment. The only catch is that further down the income statement, they subtract out the 51% of earnings they don't own through a minority interest line item.
So they're boosting the most important line gross margin and pushing the offsetting loss further down the statement. That is very clever. It's designed specifically to address what the market is punishing them for.
Exactly. It's a move designed to bend that margin curve sooner than anyone expects. And they also got a call option to buy the other 51% later on if they want.
That sets us up for the forward outlook. Management reaffirmed their full-year guidance. Does that guidance actually reflect this brutal fight they're in?
Oh, it absolutely does.
Yeah.
The guidance they reaffirmed is, well, it's muted. It's painful, frankly. They're projecting organic net sales will be flat to slightly down for the year. So somewhere between -1% and +1%.
And earnings.
The earnings trajectory is negative. Adjusted EBIT is expected to fall somewhere between 9 and 13% year over year. Yeah. And that translates to adjusted EPS of between $2.45 and $2.55, which is a decline of 12 to 18% from last year.
So management is basically saying Q1 was what they expected, and the whole year is about defense and mitigation, not growth.
That's the frame. Survive the inflation, survive the tariffs, and pivot upmarket with Raos. But the guidance is clearly telegraphing a year of shrinking profits.
Which brings us right back to the stock drop. If the CEO says we're on track, but the market sells off 5%, it's a vote of no confidence.
That's right. The market is looking past the small beat and focusing entirely on the future slide in volume and EBIT. And you have to put in context. I mean, CPB has been a massive underperformer.
Give us the numbers on that, because that context is really important here.
Over the last year, Campbell's stock was down a staggering 34.0%.
34%.
Now compare that to the broad consumer staples ETF, the XLP. That was down only about 2.7 to 2.9% over the same period. So CPB isn't just underperforming. It is structurally broken relative to its entire sector.
It's a deep tension. Management says the plan is on track for their subdued guidance, while the market just sees a continuous, painful grind.
The market is basically screaming, show us the execution. The plan isn't enough.
Right. And that is the conflict.
It is.
Welcome to our final segment, where we put on our most aggressive trading hats. And remember, the fine print. This is purely to analyze the dynamics of the call and pitch an outrageous but plausible trade idea. It is not financial advice.
Okay, so the thesis here starts with one simple fact. The market has completely overshot to the downside. The stock is trading at a severely depressed valuation, pricing in the absolute worst-case scenario.
Which is what? Continuous volume bleed and no relief from tariffs.
Exactly. And we think that fear creates a really interesting growth and margin arbitrage opportunity.
So we're talking about going along the Campbell Company here. What's the catalyst that the market is missing right now?
The market is fundamentally mispricing the immediate impact of the La Regina acquisition. They're so focused on the weak guidance that they're underestimating how much that 100% P&L consolidation of a high-margin business can bend the gross margin curve in Q2 and Q3.
So that margin engineering provides a floor under the stock.
A tangible floor, yes.
But where does the real upside come from? What gives the stock the torque to move, say, 10 or 15% higher?
That torque comes from one place and one place only. Goldfish stabilization. Management's conviction that the snack segment will stabilize in the back half of the year is the upside catalyst.
So if Q2 shows any sign at all that the bleeding in snacks has stopped?
If it shows any confirmation that they're turning that ship around, the stock is poised for a significant mean reversion bounce relative to its peers. This is a bet that internal execution, the cost savings, and the Raos integration will overcome the macro headwinds faster than the current stock price implies.
A compelling bet on flawless execution in the face of some serious macro pain.
It's a high conviction call on management's ability to deliver.
And that wraps our deep dive on the CPB Q1 results. We saw a consensus beat that really couldn't mask a deep decline in profitability, all driven by this structural fight against tariffs that's forcing painful choices on pricing and volume.
But we also saw the company fighting back with a really powerful strategic move, locking up the supply chain, and, more importantly, the margin capture for their star premium brand, Raos.
So as you think about this, here's the final thought. The new CFO said on the call that CPB's brands have a right to win.
And you have to ask yourself, given the immense pressure on core soup and the volume struggles at Goldfish, is that long-term brand equity actually strong enough to win against today's price-sensitive consumer and these brutal tariffs? Or is this quarter just one inline stop in what's going to be a very long, very painful multi-year recovery?
A question that means next quarter isn't just about the numbers, it's about proof. Thanks for joining us for this deep dive. We'll catch you on the next one.